Good day, I am Dr. Suresh Rama, Head of Rates and FX Strategy at the RHB Group. At today's podcast, I'd like to discuss about the trajectory of US monetary policy. We believe the current pattern and trend of rate hikes by the Fed and the signals by the Fed closely resembles the June 1999 to May 2000 period of tightening cycle. This suggests that Fed fund rates would eventually settle around the 1.75 to 2% rate and fall short of the terminal rate that the market is currently pricing in excess of 2.5%, which means if the Fed intends to avoid a hard landing or a possible recession, the Fed fund rates would lean closer towards 2% and below, possibly between the 1.75 to 2% range, which also suggests the risk is US Treasury 10-year yields may need to unwind the excessive tightening that is currently being priced in. For the dollar, it has peaked, and this suggests the risk of the currency coming off as the Fed pauses on interest rate hike post the July FOMC meeting. The sustained rate hike that occurred in March to July would need to filter through into the economy as it puts a lid on inflation pressures in the economy. For the US 10-year yields, we believe the process of consolidation is likely to occur post-July FOMC meeting as fixed income traders evaluate the decision by the Fed to pause after the July meeting. We believe the risk is US 10-year yields to come off and stabilize similar to the pattern noted during the June 1999 to May 2000 tightening period by the Fed. On the FX positioning front, we note Commodity Futures Trading Commission data for the week ending 24th May showed that speculators cut their net long dollar positions to $17.437 billion from $19.75 billion previously. In the fixed income space, speculators' bearish bets on 10-year Treasury futures were increased to 225,000 contracts for the week ending 24th May against 160,000 contracts the prior week. But benchmark US 10-year yields have been declining from a 3.2% high on 9th May, reflecting a shift in investors' concern from higher interest rates to recessionary risk. In the dollar ringgit space, further retrace for the pair could take it towards 435 support level as the market unwinds long dollar positions. We believe importers are positioned at sub 435 to take up bids on the dollar at these levels. Levels of 440 and above is clearly an overshoot. Thank you for listening to this podcast and wishing you the best in your investment plans.